This is Eric Muathe with Muathe.com again. Let me go back and clarify a point based on a question I had on the message board. Now the question is whether we use the 200-day moving average as the entry price. Now what we look for is for a flat 200-day moving average that was preceded or around the same time with a flat 50-day moving average. And what we are anticipating, and this is where we are trying to find the opportunities, that with this continued move in the stock and a slight uptick in the 200-day moving average, at some point there's gonna be a crossover. Now traditionally, many of the technical analysts use that exact point of the crossover as the buy point, but what I'm saying with the Muathe Virgin breakout is that you play this here to here, and this period here is where prices have to accelerate very fast so that this can happen, the crossover can happen. So we don't wait for the crossover, we want to play this setup. We anticipate that there's going to be a crossover in the future, and the only way that can happen is by the only way it can happen is if prices move significantly. And you don't have to worry so much about when you're going to sell, because all these moving averages are based on the close of a stock. So the stock has to close strong repeatedly for this to move. Otherwise, intraday action the close would be meaningless if they closed weak but the stock was high during the trading day. So the only way you can affect the 200-day moving average or the 50-day moving average is with continuous and repeated positive huge closes on a stock. Okay, so now let me take that off. So to clarify again, we never use the actual 200-day or the actual 50-day moving average for the entry point. What we look for is for the highest close above either the 50-day, but in this particular method, for a good profitable trade, what I'm looking for is I want the 200-day moving average to be flat, and I want to use the highest close while the 200-day moving average was flat. In this particular example, and I think in introduction 3, I talked about it, is sometimes the highest daily close while the 200-day moving average was flat happens to be below the actual 200-day moving average. Usually you'll find that the close is above this. In this particular example, before today's 10% plus move, we had anticipated that since this is relatively flat, the highest close is what I'm calling the flat pivot or buy point, and that was at 37.46. So this would have been your entry point around 37.46, because this is the highest close while this is flat. It also happens to be the highest close while this 50-day moving average was flat, somewhere around here. So you can use this as a powerful indication that the 200-day moving average and the 50-day moving average both want to move higher, with the 50-day moving average accelerating its pace and eventually moving above the 200-day moving average, and that's where the money is made. So just to clarify on this video, your entry point is always the highest close above either the 50-day or the 200-day moving average, but more so you want it to be above the 200-day moving average. Now, we've had a good move in the stock. Usually they'll move higher. There'll be a shakeout here. It's just how it is, and it's because of all these sellers here want to get out. Immediately they see the stock move up, they want to sell. So there's always some shakeout, and what I'm saying is let's hold through the shakeout and see whether we can get another move that will take us probably in the 50s or 60s in this stock in the coming weeks. So just to clarify that point, I hope that was helpful. This is Eric Muathe, Muathe.com as always. Peace and blessings to you. Good luck.